Hey guys, Red here, Section 8 guy. Thanks for watching. If you're new to the channel, don't forget to subscribe, like this video, and leave your questions and comments below. I'll get to all of them. Today I want to talk to you about the risks of investing in real estate. And the answers I give you might be a little bit different from the answers you hear in other places or the answers that you have thought about yourself. And I'll tell you why. The number one concern about real estate is, you're buying at the height of a market and eventually, it's going to crash and you're going to be underwater on the home, meaning you're going to owe more than the home is worth. Okay, that's called being underwater. Now, that's exactly what people thought in 2009, 2010, and 2011 when the real estate market plummeted following 2008, right? And property values fell astronomically. People had these loans and everybody was underwater. Now, the thing about real estate investment property is you only lose money on your real estate or real estate in general. Same with stocks and investments in anything. If you sell when you're down, okay? So for example, somebody is going to buy a property the day before the real estate market crashes. Okay, the real estate market's not going to crash for a long time, if ever at all, right? The investment, the stock market, it's going to see a correction just like the real estate market will. It could be 10 years, could be 1 year, could be 20 years, who knows? Someone will buy the day before a crash, okay? If that person sells the day after the crash, they're going to lose all their money. If they wait a couple of years and then sell, they're probably going to make more money than they did when they originally invested. Look at the people who bought in 2008 when the stock market crashed. If they still held on to those properties and they sold today, would they make money? Of course they would. They'd probably double, triple their money. At the time, they said, oh my God, the house is only worth this. If you hold the property long enough, you'll make money. If you hold the stock long enough, you'll make money, okay? Unless you buy a property in Flint, Michigan, okay? Or the south side of Chicago, in which it may never appreciate, it will continue to lose value. All right. Now, you'll never lose money on the actual property. So don't think about that. Don't worry about a crash, because if you're investing for high yield cash flow returns, it doesn't matter what the value of the property is. Okay. The only ways you can lose money investing in property, specifically property with tenants for cash flow, is if you have a bad tenant. Okay. Bad tenants, they stop paying rent. They're destroying the unit. The thing about bad tenants is we can try to mitigate that as best as possible. We can do as much due diligence up front and try to find the best tenants we can. We can do Section 8, where the government's going to pay a large percentage of that, regardless of what else is happening in the stock market. We have been shown, if anything, in the last couple of years, that if the government needs money, they will print more, right, to make sure that you guys are paid. So don't worry about that. When it comes to real estate investing and investing in property, is a bad tenant a risk? I guess if you choose a bad tenant, or you don't do Section 8, you do another kind of investing, whether it's straight cash and you invest in somebody, because at the end of the day, you are investing in someone because they're the one that's going to be paying you the rent over the course of time. You can look at it like that. So you want to choose a tenant in a straight cash rental and they lose their job and they can't pay the rent anymore, that's a problem, which is why I love government subsidized programs like Section 8. But in general, that is a huge risk. The tenant is a big risk. It's more of a risk in my eyes than whatever the market does, because I'm not planning on selling anytime soon. So I'm planning on holding and grabbing cash flow and a high yield return. So I'm focused on that. So I'm not focused on the price of the unit. Price of the unit could be $1. It doesn't matter. It could be $1, it could be $1 million. I want the cash flow, okay? So, and secondly, a bad property. If you make a bad investment up front, guys, you don't do your due diligence, you have a bad contractor in there, and you buy a property that has serious issues, you buy a property that has asbestos, you buy a property that has, some kind of, maybe it's in a flood zone and you don't take out flood insurance. You buy a bad property, that property gets wiped away, or something bad happens with that property, it has a bad foundation, you don't see it, the house caves in, your insurance doesn't cover it for some reason. Whatever it is, A bad property is on you. That is a risk of real estate. But that's also, again, guys, these are risks that can be mitigated. So when I look at risk, I think of okay, here are my risks. Here's how I can mitigate those risks. All right. And I'm coming from a place where I've had Section 8 and rental portfolios of all kinds through government shutdowns, global pandemics, and small scale recessions. And everything's more valuable than it has been. It's survived everything. So, okay, so bad tenants, we can mitigate that, right? By doing our research, doing our due diligence, looking at financial histories, background checks, criminal histories, finding the best tenant possible, okay? We can mitigate it even more by doing a government subsidized program like Section 8. So I cross that off my risks, okay? Bad property, let's do due diligence up front. Let's get a good contractor to get in there and do work, okay? Let's find out what our contractor sees, what's the scope of work, do my due diligence, make sure the property is good, has good bones, good foundation, good structural integrity, okay? Boom, I mitigated that risk, it's a good house. Okay, here are my risks. What are you waiting for? See you next time.